Welcome to the daily update, where I'll go over the action in the market for Thursday, August 1st, and then we'll see how things look for Friday, August 2nd. Pretty significant down day. Hasn't done an awful lot of damage, at least to the broader market, but it kind of took a lot of folks by surprise. We were looking like we were going to continue to go up, at least as the market opened, and then everything hit resistance, at least in the S&P, reversed, went down, filled the gap, and just kept going after that. We still remain negative in the short term, and we're well below the 20-period moving averages, where we had been between the simple and exponential moving average. Well, we're well below that, and we're back down to the 50-period moving averages again. So we've been just ping-ponging up and down. When we're really going to look at being more negative is if we go below and close below the 50-day moving averages. That, especially in Friday's session, which we don't know how the market's going to react to the employment situation report. But if that does happen, that's going to be a daily chart and a weekly chart that are both below significant support. And that's going to make the technical picture look a lot more negative. Of course, the opposite could happen. We're at support again. We could bounce up off of that. Now, as I started recording, the futures are down over 0.85% or so. The earnings reports that were released after Thursday have not been well received. And so, at least through the night, it looks like things are going to remain negative. Now, through the night before today's session, things looked rather positive and then turned negative during the day. We'll see if the opposite of that has a chance of happening on Friday. Okay, I have this thing called the SPXInvesting Program. If you're more interested in learning about that, it's still wide open for right now. I'm going through the process of trying to lock that down. There are links in the description below this video that not only talk about the program, but have links that will take you to the website, or here's an email address to contact me. The daily video that you're watching right now, that's the real foundation of my analysis. Coming up to the weekend and all these other videos around the outside, I will be preparing, but they are meant to augment the daily video itself. And also at the very top, supplemental videos, I'm not really publicly posting those now. I have a lot of ideas. There'll be a lot of additional videos that once I lock down the website will be available that go outside of what I really talk about from day to day, but are still related to that nonetheless. All right, let's go back and talk about what happened and then look at some charts. We did have a higher open. Looked like, okay, here we go. Prices climbed up and actually got above R1 at 55.51. Then we reversed. We went back below R1. We went down below the daily pivot at 55.23. Then we went below the unchanged level and we went all the way down to S1 at 54.94. So we broke down below the 55.50 level, or actually below the 5,500 level, excuse me. Then we just kept going. We kept declining. We tried to find support at S2 at 54.65, kind of slowed down a little bit, but then we just started declining after that. We didn't get all the way down to S1. I had that calculated. It's not on the chart for today. We were just a few points above that at 54.07. Then we rebounded a little bit into the close, just a little bit below 54.50. So we were down 1.37% on above average volume. We are still negative in the short and intermediate term. We're still dangling around the 50-day moving averages, so that's still the line in the sand to see what's going to happen there. And it appears as though bad news is becoming bad news now. There was weaker than expected economic reports that came out. There was also another report that the market could have latched onto about employment cost and productivity that I'll go through. That was actually quite positive, but the market just decided it wanted to be negative. Just like in Wednesday's session, it decided it wanted to be positive. That's just how these things work out sometimes. And there's really been no change to the overall inflation and interest rate scenario. We'll see if that scenario is modified after the employment situation report comes out, because that's kind of the big area that folks are really focused on right now. The geopolitical concerns, things are stepping up a bit in Israel and actually getting to the point where it could become more regional, more Middle East, with Iran making threats directly at Israel instead of using proxy Hamas and Hezbollah and things like that. They're actually talking about something directly happening after Israel had retaliated and took somebody out in Tehran itself. Again, the market's not really all that worried. We're not seeing oil really bouncing up all that much right now, but if things do really escalate, this could come over and really spill into the market and have an impact. Okay, some comments. We saw a broad-based decline. Where is the love for the small caps? It seems like it certainly wasn't there on Thursday. Growth concerns now in this weak economic data that I'll talk about. This is now causing bad news to actually be bad news. So we'll see in Friday's session is if the report comes in friendly, is that going to be taken as good news or bad news? Parabolic SAR. This is kind of interesting. Even with the down day, the parabolic SAR has switched back over to positive. And I was posting things on the website. Just be aware of that. I consider this to be a primary indicator. No indicator is perfect. And there's been some times when the parabolic SAR has been wrong. We'll have to see. Is this seeing some positive action coming into the market? Or are we just seeing an erroneous indicator signal for right now? And eventually this will switch back over and be negative. We're back down to the 50-period moving averages and a little bit of a list here with the Stochk RSI and Williams percent R. They are extreme negative, and the slope oscillator and all of our momentum oscillators continue to be negative. Intermediate term, we're still looking pretty positive. When you take the 10-day moving average of the new highs minus the new lows in the S&P, it's coming down and it's just barely extreme positive, but it still is extreme positive. And long term, the 150 moving average dropped off, but the 200 period moving average, that's still extreme positive. So this is suggesting with the intermediate term, the 10 period moving average, and then the longer term 200 period moving average, this is still suggesting longer term positive momentum. And we don't want to lose sight of that. We haven't really shifted over to a full-blown negative environment. We're still looking at a longer-term uptrend here, not like back in 2022 when we saw a longer-term downtrend. And that's why we need to pay attention to these extreme negative readings more closely, because we could bounce up off of those. And there, I ended up closing some positions where we went right down to a support level, bounced up off of that, and I just decided to get out, even though I was playing the side where you could make money when the market goes down, because we really need to pay attention to those in this kind of an environment, because we're still positive in the bigger picture. There's really no change here. The market is really, really anticipating a rate cut in September. It's pretty much 100%. It's just how much. But according to the charts that I'll go over this weekend, they really expect that to happen. The question mark is what's going to happen if it doesn't? And what's going to happen if things start to change and all of a sudden it throws a lot of that into doubt? That could really put some pressure on the markets because they're trying to front run this, as markets do. And if that scenario does change, then this could really also put some pressure on the markets. The dollar was up, which pressured stocks, and interest rates were down, which could have given support to stocks. And what's interesting is we've closed below 4% now with the 10-year yield. We're at 3.98%, where we had been at 4.11%. Didn't seem to help stocks all that much on Thursday. We're still inverted with the yield curves. They're a little bit less inverted than they were before, but still inverted nonetheless. And we are now negative as far as sentiment. We had been at 52, which is neutral. We dropped all the way down to 40, which is now negative. Our trend is still negative, and we've been seeing this all along with the ADX weakening below its moving average, but it's still above 20, so that still counts as a trending environment. But the red line is on top. And with the down day, our bias is negative, and that's what I do with just up day, down days, usually the bias. And the momentum, I'm still keeping it mixed because we're right at that 50-period moving average. We could see a bounce up off of that as well. The economic reports, we got the weekly jobless claims. They came in stronger than expected, and we're seeing a bit of a trend here now with the moving average going up. And I'll show you the chart. They came in at 249,000, more than the 233,000 they had expected, and up from the 235,000 we saw last week. And continuing claims are going up as well at 1.877 million, up from the 1.844 million that we saw last week. Second quarter productivity, the preliminary reading came in stronger than expected at 2.3%. They expected it to come in at 1.6%, up from the 0.4% that was last time. This is kind of a big one too, is the unit labor costs up 0.9%. They expected 1.7%. Last time it was at 3.8%. So this decline, and I pointed this out in one of the videos that I post on the website, is that we're seeing productivity going up and costs going down. Now, that really sucks if you're an employee, but if you are a manager or an owner of a company, you like this. You want productivity to go up, and the cost that you're paying for folks to work for you, you want that to go down. And this was the good news that the market could have latched onto, but it didn't. Then we look at U.S. global manufacturing, came in at 49.6. The takeaway from this, and I don't have a chart of this one, is that we're below 50. When we're above 50, that shows expansion. When we drop below 50, we are showing contraction. Construction spending was down 0.3%. They expected it to be up 0.1%, where last time it was down 0.4%. There's another big one, ISM manufacturing. And this is kind of what the market latched onto. It was when this report came out, which is about 30 minutes after the market opens. That's when everything switched and started to go more negative. And this is bad news. So now we have bad news being bad news. It came in at 46.8, well below that 50 level, showing contraction and well below what was expected at 48.5 and down from the 48.5 that we saw last time. So this is producing some concern. All right, here's a chart, the weekly claims. We look at how they've been moving up with the week over week score, and the blue line is a 4-week simple moving average, which is also going up. This is suggesting some weakness in the employment situation. We'll see if that comes through in Friday's report. Continuing claims also going up, and the trend is also higher when we look at the moving average. And here, this will be updated again after Friday. This is trying to put initial claims in red, continuing claims in blue, and the unemployment rate in black, just to put everything on one chart. Although the previous chart's a little hard to read, so I blew it up here. We have that huge skew because of the COVID crash and all the crazy stuff that happened then. All right, then we look at productivity and unit labor costs year over year, or the cost, the yellow line, that's going down and the productivity is going up. And that could be considered good news unless you're working for a company like this. Construction spending is continuing to decline, even though it's still positive on a year over year basis. Private construction, we look at residential, which did decline, and non-residential is also declining, but still positive year over year. And then month over month, construction spending was negative, but a little less negative than what we saw in the previous month. The ISM, still below 50. And we're seeing the blue line going down and the yellow line going down. And this is showing a contraction on the manufacturing level. Then we look at prices and deliveries, where the deliveries are going up and prices are actually declining a little bit right now. And then exports versus imports. The blue line are exports. That's ticking up just a little bit, and we ticked up a little bit with the imports, but also still both of these are below 50. And then looking at how we're trailing off a little bit here, which could be showing some economic weakness. Now, you would think with the market saying, oh, yeah, they're going to cut rates in September, this would be welcome news. But again, that would be bad news is good news. Well, at least in Thursday's session, bad news was treated as bad news. All right, some Isabel Net blog charts. There's a whole mess on here. This is just looking at the advances and declines and what the averages are over a period of time. You might want to stop this and look at it. I'm not going to really dive into this too deeply, but this can be kind of interesting to look at and where we are in perspective of the bigger picture. And corporate buybacks, where we're seeing it trailing off just a little bit with the 4-week average, even though year over year, it's still continuing to advance. Monthly flows from global investors to developed markets and emerging markets, still seeing a lot of money globally that's going into the different markets around the world. where you have the passive. These would be like index type funds, and active funds. This would be like an actively managed mutual fund or actively managed ETF. But a lot of money is really going into the markets right now. And then the second quarter is expected to be the first earnings per share growth quarter. Okay, and I can't see this. I have to move this bar. For the other 493, yes. It's been the Magnificent Seven that have really been driving the earnings per share up. That's the dark blue. Or the rest of the stocks that make up, the Marianne and Professor part of the S&P, the rest, it's actually seeing some positive earnings per share growth as well. And that is helping the broader part of the S&P to hold up a bit better. Then looking at debt allocation is at 20%. So this is just showing the debt means bonds, where it's still going down overall because bonds just got decimated back in 2022. And so folks are a little bit leery, even though we're seeing a lot of money going into bonds. In the bigger picture look, it's still not showing an awful lot of strength right now. All right, just one chart to show you here from Yardeni. This is just showing how the 10-year yield dropped below 4% here. And this is the constant maturity. So this is a bit of a different way of looking at this. And this is the red line are the tips. These are Treasury inflation protected securities where they adjust more for inflation as well. So just to give you a little bit of a different perspective here, we did close below 4% here, but we're still above the 4% level according to this chart. And some interesting charts here, which you would think this would tend to be positive. This is called the Panic Index. And I believe it's put out by Goldman Sachs, where a lot of times when we see a really high reading here, that can mark some kind of a bottom in the market. At least that's what's happened before. Well, we aren't really seeing it follow through, at least to this point, where this is giving us a very, very high reading. And you would think this would help the market go up, and it still could. We could still turn and bounce up out of this. Now, this is before Thursday's decline showing in this chart here. And then looking at how the NASDAQ underperformed by a historic amount in July 2024, this is how it underperformed the small caps. And this is something to be a little bit concerned about. Kramer is bullish on NVIDIA. He says it's trading at a discount and you should buy it. And for those of you who like him, okay, maybe you'll go buy some NVIDIA. For those of you that pay attention to his track record, he's pretty good at being a contrarian indicator. If you do the opposite of what he says, you'll probably end up doing better. Then looking at either plus or minus 5% moves once their earnings come out, we're seeing really big volatility. Once these companies come out with their earnings in the S&P, this isn't saying positive or negative. This is just measuring how much do they move after their report actually comes out. And it's very, very high. And I'm going to show this in the intermarket analysis video over the weekend. This shows the different 11 sectors of the S&P 500 and how big they are. The bigger the bubble, the bigger impact that sector has. You can see we're tech. And then inside it has, okay, what are the big companies inside of those sectors? So this just gives you a little bit of a graphical representation of things to see it in a little bit different way. That's why we follow Microsoft, Amazon, Google, and let's see some of the other companies here that we don't really follow. These are the big Magnificent Seven, the big bubbles in here. And that's why at least we look at their charts. I don't trade them. We just look at them more for informational purposes. All right, here's our chart where it looked like we were just going to go back and start to go back up after the Fed made their announcement on Wednesday. We had a positive open. We got above R1, and then everything just kind of stopped once the ISM manufacturing came out. We came back down. It looked like, oh, no problem, no problem. We'll just, come down here to the unchanged level, which usually acts as a support level on an up day. We sliced through that, baby. Went all the way down, sliced through S1. We tried to slow down around S2 with a little bit of a bounce there. That wasn't happening. We broke down. S3 was right below where we ended up hitting. And you'll notice kind of a pattern here where we were having this overhead resistance going back to Thursday, the 25th, and we were able to gap above that, okay? And then we went up enough to fill this gap that went back to the gap from the 23rd to the 24th. Then once that gap pretty much got filled, what often happens is we see a reversal. And that's what we're seeing right now. And then we were above this, which was really causing some overhead resistance. We gapped above that. But now look at what we're dealing with down here. And it's never exact. We're just dealing with some support levels right here. And that's around where we saw prices start to bounce up going into the latter part of the day. We were still down pretty significantly, but well off the lows of the session. Then we're down again here as we're dealing with the overnight session from Thursday to Friday. We're still seeing where value is outperforming growth. They both got hit pretty hard, but growth is underperforming. This also shows over the last number of days intraday how growth has been underperforming value for the S&P. Here's our end of day chart. Growth just got hammered, down 1.9%, where value was down, but down 0.65%. And growth was down more with the mid caps and more with the small caps as well. So you can see nothing but solid red here. And we ticked up a little bit with the growth to value ratio with the small caps, but still, we're starting to see a death cross here with this ratio. And we really underperformed with the mid cap growth to value. And we also underperformed with the S&P growth to value. So it was not a very good day in that respect. This is something that we're kind of hanging on to that could potentially be positive. With this growth to value ratio, a couple of ETFs, we came down to the 250 period moving average, and we've been bouncing up off of that. Now, we fell in Thursday's session, but not down to this level yet. We saw this with home construction, comparing it to bonds, where we came down to the 250-day moving average and then bounced up from there. Is something like that going to be able to happen this time? That would be the positive side. If we still see this ratio going down and dropping below the rainbow, that means that things could be turning much more negative from a growth to value perspective. And we saw discretionary underperforming staples. Large cap growth, which never could seem to really get back above its 50-day moving average. It's down well below it, but it's still above the 100 period moving average. And we ticked back up here as small caps just had a really weak day after doing quite well. That's when we see this ratio going down. When small caps underperform, we see this ratio going back up. And this is encouraging too. The Wilshire 5000, this is a broad market measure. We're still above the 50-day moving average, even with the decline. Are we building some kind of a base here that we're going to be able to launch up out of? Or is this just a plateau that we're resting before we get ready to fall off a cliff? You can make a case for either side currently. Looking at our trend, we are negative. The ADX is still below the moving average. It's trying to turn up a little bit here, but the red line's on top, and now advancing where the green line is declining. So this is negative. We're also negative in the short term with the red line on top and advancing. And we are above average with volume. So much for the summer doldrums that we're supposed to see right now. Volume is really, there was one day when we were slightly below average, but other than that, volume has been pretty hefty, both on the NYSE as well as on the NASDAQ. Sentiment still shows, according to the Ulcer Index, that fear is pretty high. And then where we might have overdone it to the upside on Wednesday, well, we might have overdone it to the downside on Thursday. This is just a one-day rate of change, just measuring one day to the next. And when we get up above these blue or green areas, it means we may have gone too extreme. When we've really gone extreme is when we get up above the red line on top and this kind of purpley line down here on the bottom. And again, it doesn't necessarily mean a reversal. It could just mean some kind of a slowdown. Well, from Wednesday to Thursday, it did mean a reversal was happening here. And with the down day, we're seeing the VIX really starting to go up pretty severely, both with the line chart and the bar chart. And the VIX of the VIX closed a little bit off of the high here, but it's going up as well as the volatility of the VIX continues to pick up. And the momentum of the VIX continues to be higher or up. And this is what we're seeing if we match up with what has seasonally happened before. We did go up with the one-day equity put call ratio, but we're still going down with the 5-day, and we're still going up with the 10-day. So, hey, roll the dice here. Typically, when we're going down, that is negative for stocks. Is that right? And then when we're going up, that tends to be more positive. Maybe I have that backwards. I always have to look at this and think it through. We are seeing, though, where volatility risk premium is still dropping very low. It had been very high. It's really coming down and dropping below the band here. And we saw this fear gauge tick, well, it was up just a little bit, but virtually unchanged, where the other fear gauge that we follow also increased. So there is an increase in fear currently. We're seeing the risk on to risk off ratio declining now. We're actually falling out of this range that we've been in for most of 2024. This is more of a risk off type of look. And we did get the latest reading from the American Association of Individual Investors. Now this is a week ago, and they were more positive on the market, but not necessarily extreme. And we're holding up here. We came down with the advanced decline line based on price. We declined based on volume. That's the positive part. We're well above the moving averages. The negative part is we're rolling over a little bit based on price, and we've been underperforming based on volume. That's a negative divergence between price and volume. So there's a positive side and a negative side with this chart. This is also holding up fairly well. With the move higher, we saw an increase in new highs. It was off of what we've been seeing, but it's causing our 5 period to go sideways. Our 10 period is still declining. But this is still looking fairly good internally for the S&P because we're back down to the 50-day moving average where we were just a couple of days ago. So there wasn't a real chance for a lot of new lows to be generated. And we're still looking okay here. Even though we declined, the advanced decline ratio is still positive. And we're negative, though, when we look at accumulation distribution. We're below the moving average, and the moving average is declining. We're back below the midpoint here with the boom indicator. And we're looking negative and maybe getting to an extreme negative reading here with the chicken money flow. But for right now, it's just solidly negative. And the chicken oscillator turned back down after being extreme negative. It bounced back up. Now it's not quite extreme negative again. So our smart money indicators, all three charts, continue to be negative. And we saw the cumulative advanced decline line on the NYSE for the first time in a while actually come down and drop below its 50-day moving average. But if you look at the regular NYSE advanced decline line, just a little tick down, nothing too severe. We're still hanging in there with that. This other NYSE advanced decline line also came down slightly, but is still holding up. And we're seeing that negative divergence here. When we look at the NYSE advanced decline line based on price, it came down where we never came back and broke above this previous high based on volume. This is where we're also seeing a negative divergence. A little bit of a tick down with the cumulative S&P advanced decline line, cumulative here, tick down, and we never came back to this high where it looks like we were breaking out based on price, and we never did do that based on volume. And the NYSE advanced decline line is continuing to hold up better than the S&P, even though they're both down. And we look at our advanced decline line studies here. We declined across the board, but we're still above the moving averages with all the different indexes that we follow. So we're back down in 50 moving average land with above average volume down below. And we're just barely extreme negative again with the Stochk RSI. We had worked that off with the up day. Well, now we're just barely starting to get extreme negative again here. We're barely extreme negative by 0.01 here with the Williams percent R. The CCI 14 is not extreme, but is declining, and the CCI 20 also declined, but is not extreme, at least yet. And we're seeing kind of a real battle going on here with the 20-period moving average study. We were trying to break above the blue and the green line. Well, now we're back down below the blue and the green line. And we declined with our 20, 50, and 200 period moving average study of the S&P. We're also negative with the force index. We had gone extreme, well, not quite extreme negative. We had gone negative with the force index. Then we had the update, it went positive. Now it's back to being negative again. And we're not really seeing anything extreme here. The stochastic study, we did decline in the short term, but we're not extreme, rolling over in the intermediate term, and actually still trying to turn up in the long term. Do you think the market's a little confused right now? And here's the 20-period moving average study. We were right in between both the simple and exponential. Now we're comfortably down below them, and we're below the midpoint. We were showing some improvement here with the standard deviations chart. Now we're into the -1 channel. And we declined and are negative with the balance of power. We're on a no-go with the no-go system. We're dealing more with the lowest low value here and dropping back below the midpoint with this chart. TTM squeeze still continues to trend lower and is negative. Here's our 50-period moving average study. Never did get above the red or blue line here. Maybe that's acting as some kind of overhead resistance, and now we're starting to fall down, and we're seeing the red line dropping below the blue line because that moves faster. This is showing that there's some real vulnerability now with the intermediate term trend. And we're back down to dealing with the 50-period moving averages. Again, we want to keep an eye on the 100s if we start to fall even more. We are negative with the ease of movement. We're negative with the Arun. We're still positive, even though we declined with the S&P McClellan oscillator. So we're going up based on price and down based on volume, another negative divergence that we've been watching. We decline with the NYSE McClellan oscillator, but still positive. So we continue to go up with the summation index based on price. Looks like we're ticking down just a little bit based on volume, but almost negligible here. And we're still positive with the Swenlin trading oscillator, even though we were flat based on price and we crossed back above zero based on volume. So that's hanging in there for the time being. But the momentum, the PMO is going down, but we're still going up based on price, going down based on volume. We saw some weakness with the PMOs that are rising. We're starting to go down with the buy signals, and we're flattening out with the PMOs that are above zero. And we've gone from being positive to neutral with the Elders Impulse System for the S&P. This is the big change here. There was just enough of an uptick in Thursday's session to generate a dot underneath. We want to respect this, but also go, wait a minute, what's going on? All our other indicators are still more negative. It's probably going to be the 50-day moving average. If we can stay above that and bounce up off of that, that would justify this positive signal. If we drop below that and start to clear these previous lows, this could quickly turn back with a dot on top and switch more to a negative signal. And we are still extreme negative with the slope oscillator. This is a short-term oscillator. We're also looking negative with the MACD. So with all of our oscillators, short, intermediate, and long-term, we continue to be negative. And we're, again, right back at the 50-day moving averages here. And we came down after being extreme with the bullish percent index. We did fall back, which on a down day could be expected. But this overall has been holding up fairly well as the rest of the S&P has been hanging in there, even though the Magnificent Seven stocks have been getting hammered. And this is also still looking quite positive. The NYSE bullish percent index, it ticked down, but we're getting a very, very high reading here. Maybe a little too high with this reading. And we ticked down, but we're still negative with the NASDAQ 100 bullish percent index. We saw a nice little bump up on Wednesday, and then we ticked down on Thursday. And the money flow is kind of jumping back and forth between the 50 level. It's now back to negative. We're turning down and still negative with the ultimate oscillator. The Vortex still has the red line on top. That's negative. We're below 50 with the RSI 14 and 9, so that's negative. As we've been bouncing around more range bound the last few sessions, the standard deviation is really starting to slow down, but still above the moving average. We're still above the moving average here with on-balance volume, but we did decline. And we saw a little bit of weakness, but we're still positive with those stocks in the S&P above their 20-period moving averages. Coming down a little bit here with the study that we watch, declined with the 50-period moving averages, but still positive. Declined with the 100 and also declined with the 200. But these are still positive when taken in the bigger context. On a momentum basis, though, the Copic curve continues to be negative. The Pring bottom fisher, that looks like this buy signal could be getting ready to go away. That's interesting how it even generated one to begin with. And this is interesting. The mass index could be getting ready to tell us something. We have crossed above the red dashed line. Okay, that's part number one. There's three parts to this. Part two would be if we go above the blue line. Okay, and then part three is going to be when we come back down and cross back below the red dashed line again. Whatever is happening at that time, the mass index is suggesting a reversal. It doesn't necessarily pick direction. It just says we're going to reverse from what we were doing. So we want to keep an eye on this one. And we came back down more neutral with the Sean trend meter. And the reason I'm showing the itchy and scratchy cloud here is because we see the blue line below the red line now. That's turning things more negative, and we're also seeing the green line continue to decline. We're still looking okay when we use this chart as a support area. We have not come back down to the cloud, at least yet. We're still positive here. When we look at the broad market, the 5-period moving average of the new highs minus the new lows, we're still above zero, even though we're well off the highs. And we're kind of right down here, back to this R2 level again with our weekly chart of the S&P. We've got Friday session coming up. If we close above this level, that will make things more positive. If we break down below it, that'll turn things more negative in the bigger picture. And just keeping an eye on our fib levels in case we really start screaming to the downside. We're back down below this little mini rainbow as all the lines are starting to flatten out now. And we're back below this 50% extension level here with the S&P fib chart, fib extensions chart. And we're seeing kind of a doji looking candle here, which could be a little scary for Hike and Ashy after we had been looking more positive. But we're negative with the Kegi chart, but we're still pointing up. See, really confused the market right now. We're still negative with the Renko chart, and we're negative with the 3-line break chart. Longer term, we dropped back down with the 150 moving average. We did drop down, but we're still above the red line with the 200-period moving average. And even though we're getting really close here, we're still showing good momentum with our 10-day average of the highs and lows for the S&P. And we're negative in the short term with the S&P and the NASDAQ 100. These are the mega caps that are getting hammered. And so we're negative in the short term. We're negative in the short and intermediate term with commodities and the dollar. And they should be changing the decision point scorecard, but they haven't. An awful lot of stuff being generated. Positive at the beginning, then it turned red, then it tried to get a little positive again, then it just Canada was all over the place, setting a new all-time high. Hey, oh, Canada, way to go. All right, now looking at the different sectors, utilities were the strongest, followed by real estate and healthcare. Yeah, these are more defensive areas. Oh, you can put staples into that mix too. Where tech just got hammered and discretionary was hammered as well. Energy also took it a bit on the chin. And we don't know if this is more of a defensive energy, because it could be, because it can go up or down for earnings reasons, but it can also go up or down because of geopolitical reasons. All right, the new highs, new lows on the NYSE continue to be positive. And the equal weight, even though it's declining, it's still outperforming the weighted S&P. And so we're seeing this ratio coming down just slightly here. And the Dow, it got hit pretty hard. It closed down below this pivot level, but it's still above its 50-day moving average. We've gone from being positive to negative with the diamonds, with the Elder's Impulse system. And it looks like now, anyway, keep an eye on the 50-day moving averages for the NASDAQ and NASDAQ 100. That could be providing some overhead resistance, because we just can't seem to get above that. And we came down and closed well below them again. Also seeing that with the NASDAQ 100. So the S&P 50-period moving average is providing support. The NASDAQ and NASDAQ 100 50-day is not. It's actually providing overhead resistance. So if we're going to switch back more positive, we need to reclaim the 50-day moving average with the S&P, NASDAQ, and NASDAQ 100. And we are continuing to be neutral with the Elder's Impulse system for the Qs. The momentum for the NASDAQ 100 is still negative and maybe getting a little extreme negative here. And here we're still below the 23.6 fib extension level for the Qs, after it looked like we were showing some improvement. And this is another chart of the Qs where we're just having a difficult time getting above the 50-day moving average. And in the background, we're also watching the 20-day moving average start to roll over, like what we saw back in late April into May. Are we going to see this eventually cross? Now, we're not there yet, but we just want to keep an eye on this for now. For things to turn more positive for the Qs, as I said, we've got to get back and close above the 50-day moving average. Small caps, going to the moon, right? Well, we had a bit of an aborted launch here. They were down 2.69%. And they've gone from being neutral to negative with the Elder's Impulse system. We're just a little bit below 50 when we look at the Russell small caps, with the RSI dropping down And this is never a good sign to see things looking a lot better and then just have a massive down day. We're starting to turn negative now with the momentum for the small caps. And we were seeing an improvement here with the small cap to S&P ratio starting to break out, now starting to fall back. The mid caps closed down just a little bit below this pivot point, but still above their 50-day moving average. But they've gone from being positive to negative with the Elder's Impulse system. This is still hanging in there too. This is another area we want to watch. This is the biggest ETF that I could find. It's 2,651 stocks. It's bigger than any of the indexes that we follow. I know there's the Wilshire 5000, which is like 1,500 stocks or something like that. When it was first created, it had 5,000, but it doesn't now. This is another area that we really want to keep an eye on is the 50-day moving average here. And here's Apple was down, but still above its 50-day moving average. Tesla, we're still seeing that golden cross here, but it was down pretty severely. Nvidia, well, as Kramer says, maybe, this is discount, baby. Well, we're still below the 50-day moving average. And Microsoft was down 0.3% in between its moving averages. Meta ended up being up, was able to get back above. But if you look at this, it opened higher and closed near the bottom of the bar. And that's usually not a good sign for things. Amazon was down 1.5%, back below its 50-day moving average. Google was not down all that much, but still below its 50-day moving average. Netflix was down another 0.5% in between its 50 and 200-day moving averages. The FANG index just cannot seem, look at all these closing, that's the tick to the right here. All these closing values are all under the 50-day moving average. To turn more positive, we need to get above it and close above it with the FANG index. And we're coming back down with the staples to tech ratio. After we had been seeing this really going up, this is starting to come back down, which could end up being a little bit more positive for things. We're also keeping an eye on the ratio between small caps and the tech sector. Small caps were starting to outperform. Now they are pulling back, and they're still in a longer-term downtrend when compared to tech. I haven't shown this in a few days. The financial sector, yeah, it was down, but it's still looking pretty solid. And we're coming back down with the ratio between the financial sector and the S&P. It's still in a downtrend here with this ratio, but this has really been showing some improvement. And the bank sector, really going up, looking solid. Nope, down over 4%. And we look at the regional banks, which had been showing some real improvement when compared to the financial sector. Nope, not on Thursday. And the dollar is really not going anywhere. It's been pretty much going sideways, but it continues to be in an uptrend. And we're seeing the short-term correlation between US stocks and world stocks starting to fall. But longer term, we're seeing the relationship starting to get a little bit stronger. All right, we were down with the 10-year yield, below 4%. Haven't been here since the beginning of 2024. I know I don't like to do that. I'm just using this as a comparison for when was the last time we were down in this area. And we were up with the 10-year based on price. And we're keeping an eye on this. Now, this is not an apples to apples comparison. This is the Eurozone. These are stocks in the EU, and we compare them with American bonds. And I usually go over this in the inter-market analysis video. But we're also coming down to this 250 period moving average again. Now, are we going to fall below it and keep going, or are we going to be able to find some support here? And then we're not really seeing much of an improvement with growth to value, with the Qs to S&P, with discretionary to S&P, nor are we seeing it with large cap growth versus large cap value. Still seeing weakness with the large caps, mid caps, a little bit of a tick up, but under a declining moving average with the small caps. And we're positive here with the 19-day advanced decline ratio, but we've dropped below zero based on volume. And we're still going down with the S&P to utilities ratio, which is negative. We are declining with the 2-year yield, but that doesn't seem to be giving consistent support to the S&P. It did on Wednesday, but it didn't seem to help on Thursday. And we're back to going up here with our staples to S&P 500 ratio. We want this to go down to be more positive. And we have not received the confirmation. Now, Friday is August 2nd, but we're not going to get the updated chart until Monday, August 5th. So we'll have to see how Friday plays out. But there's no confirmation, at least yet. We need 2 of these spikes. We've only seen 1. Not getting any kind of a confirmation here with the NASDAQ either. So what's our outlook during this week? And this may account for some of the gyration and craziness that we've seen. 35% of the S&P companies have been reporting throughout this week. This includes the big boys, Meta, Amazon, Apple. And Apple and Amazon reported after the close. And the initial reaction that I saw to Apple was quite negative, but then it was bouncing back up after that. When we take everything together, we are negative, and we're back down to the 50-day moving average. And we're going to get the employment situation report, probably the most important economic report of the month, as well as factory orders. And then we want to keep an eye on all the geopolitical events. Here's the finishing of the economic calendar here, as well as this calendar. Seasonally, we're neutral to negative with the Dow and the NASDAQ, where we're neutral to positive with the S&P. So not much of an edge there. These were some bullet points put out by Jeffrey Hirsch from Stock Traders Almanac a few days ago. Just kind of wanted to go through these. Well, the NASDAQ is still generating a MACD sell signal. So is that nice timing still continuing? August tends to be the first month for the NASDAQ. We'll tell August 1st that. And then we're reverting back to the mean as far as what we typically do historically. Well, we're reverting even more now. It's getting more mean. And then there will be volatility ahead. Well, that's what we're seeing right now. We typically will see some weakness from September to October. And they're still really counting on the Fed cutting rates. The players have changed, but the election year path endures. And we all kind of know what's going on with that, with the changing candidates and everything. And the best case, 15 to 25% still in play, new highs by year end. Okay. Bitcoin, well, it just got hammered in Thursday's session too. But so that cue may have gone unheeded there. All right. So Friday tends to be one of the more positive days of the week. And now we switch this around a little bit. Incumbent president doesn't run for re-election. We still end up being positive. Folks are kind of anticipating some kind of positive change in this, whether it's a different candidate or an actual different party that comes in and takes over. Or September, we just want to keep this in the back of our mind too. July tends to be good. August is okay, but it's positive. It's September when we tend to really run into some problems. And we're also saying, wake me up when September is over. But during an election year, August tends to do well. And then this, I showed this before, but it was posted again by Stock Traders Almanac, so I wanted to show it again. For the August, we're up 11 out of 18 times. We're down 7 out of 18 times. So we have a positive track record with an average return of 1.3%. Okay, warning signs. We're keeping an eye on these defensive sectors like staples, utilities, and healthcare, wondering if energy is defensive or being offensive. And growth of value, discretionary to staples, these things are just not doing very well. The 10-day put call ratio is going up, and we are negative with accumulation distribution, Chaikin money flow, and the Chaikin oscillator, even though this little bracket is off center here. The ease of movement, the vortex, and our oscillators are all negative. The ultimate oscillator, the Copic curve, is negative, and we still have negative momentum for the NASDAQ 100 and the bullish percent index. We want to keep an eye on the PPO for the NASDAQ 100. It's getting rather extreme negative. Positive signs, parabolic SAR. As strange as it may sound, it has turned back to positive. The bullish percent index is still looking pretty good for the S&P and looking really good for the NYSE. And the 5-day is going down for the equity put call ratio. The advanced decline lines, they're holding up for right now. But this is where we're seeing some positive signs. The S&P and NYSE McClellan oscillators are positive, and the summation indexes are positive based on price. But we're seeing a negative divergence based on volume with the S&P. The Swenlin trading oscillator, even though it declined and went sideways to a degree, is still positive. Bullish percent index, as I mentioned, is looking really good for the NYSE. And the money flow, it's kind of flapping above and below the 50 point now. The financial sector continues to be positive. So our conclusion, we are still negative when we take everything together and back down to these 50-day moving averages. How many times have I had to say that in this video? In the short term, we're negative and below the 20-period moving averages. And here we go again with negative in the 50s in the intermediate term. But we're still positive in the long term. That's the bigger picture that we want to make sure we don't lose sight of that. We don't want to be making big picture decisions based on short-term activities in the market. So thank you. I hope you have a really good day, and I will talk to you in the next video.